Good afternoon and welcome to today's Premium Account Short Form Market Update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Global Equity Management, Investor Signals Unit Trust, and I have over 17 years of experience in the financial services industry as a licensed securities advisor. The format for today's presentation is a short form update. We look at the macro outlook. We roll through the full ASX top 50 in light of the large price adjustment that's gone through equity markets over the last week. We discuss our option strategy and identify some of the levels that we look to reposition new long exposure into the market, and conclude with a short-term market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact myself, Leon, at investorsignals.com. Moving straight into a graph of the Dow Jones. So as we get into more than 50% of the way through the December quarter earnings in the US, it looks like US earnings are growing at about 7.5–8% on the same time last year. Now, where I see sort of the floor for equity markets if selling was to continue is if we come back to this formula here, that at 14,500 points, the Dow Jones represents roughly 14 times the $110 of earnings for the S&P 500 companies. So the relevance of that is that's where we're sitting at the moment. The current earnings in the December quarter support that $110 per annum current run rate. So if you apply a normalized PE to the market of around 15 times, the Dow Jones should, in theory, hold support at around 14,500 to 15,000 points. Where the question mark is the market is already pricing in close to 10% earnings growth over the next 12 months. So effectively what we've seen is the market starting to readjust back to the possibility that we don't see that level of earnings growth in the 12 months ahead, and that's largely been a reflection of the slower economic data that's came out of the US over the last month. Now some would argue that that's weather related with the extreme cold weather that the US has had. What we do have though is a slightly improving manufacturing and services numbers coming through both from Europe and from China. That's from Japan, I should say. On the flip side there, we do have slowing growth in China, and then obviously we've got the emerging market currency volatility all in the mix at the moment. But if we stay focused on sort of the US economy and where we see that heading, again, I think at the downside risk to the market is at the maximum we have a 10% sell-off, and the US finds support at around 14.5. I think on our domestic market, we're probably not likely to see the XJO trade much below about 48 to 4,900 points. That puts our market back on sort of a 4.5 to 4.7% dividend yield, and I think coming into the February ex-dividend period, I think our market should remain fairly well supported. I'll come back and chat about our market more as we roll through the top 50. I just want to show you, this is the 10-year bond yields in the US. So if you remember over the recordings going back a few months ago, the market was concerned that bond yields in the US were starting to get a little expensive, and obviously that would discourage the recovery in the US housing market. It makes the cost of corporate borrowings a little more expensive. Now, as we've seen this risk aversion sort of come into effect and the repricing of the growth outlook for the US market, we've seen the bond yields in the US pull back from around 3% back down to about 2.6. I think this is the range where it consolidates, finds support at around 2.5, finds resistance at around 3. We bounce sideways within that range, and I think jumping back to the equity markets again, as I've alluded to in the early recordings this year, is I think we really have to prepare for the fact that the next 6 to 9 months at best we'll probably get into some kind of support through this current sell-off, but because of the very large PE expansion that we've had over the last 2 years as a result of bond yields moving so low, I think we're in for a period of sustained sort of consolidation in equity markets, and then maybe towards the back half of this year we start to see some synchronized global growth and GDP picture at a global level starting to re-accelerate, which will sort of underpin another move higher in equities. But certainly from a portfolio allocation and positioning standpoint, we're working on the basis that at large equities move sideways over the next 6 months. On that note, let's just jump into some of these top 50 stocks, and it is designed a short form webinar today, so I'll move through them pretty quickly, and in the coming either next week or the week after we'll drill into more detail in a longer form full ASX 50 review. AGK's held up well. We continue to like that at around a 4.5% dividend yield, 0 to 5% earnings growth. It's a defensive stock. Continue to like it. We hold AGK. Asiano on the radar down here, not doing anything at the moment, but around 5.50 to 5.75 starts to look attractive again. Amcor, we've taken profit on Amcor after the recent option expiry. Down here at around $10, I think is a good buying opportunity. I think Amcor does bounce sideways and continues its sort of skew to the upside, looking for 10% earnings growth, not doing anything in AMP. The banks, from forward earnings outlook, look for around 5% EPS growth. They're now getting back to close to a 6% dividend yield. They will find support here. They're representing good value. APA not doing anything there. ASX, defensive yield name, trending back up towards 5% dividend yield. I think it will find support here. We had slightly better IPO market in the December quarter, which will at the margin help to underpin earnings for the ASX, but I think anywhere from sort of this $34 back up to $37.50 is the range, and we've largely sold the covered calls, and we look to collect the upcoming dividend. AZJ, I think this is definitely a buy on the dip, so down here for new money that's becoming available, we start to look at AZJ in the weeks ahead. BHP, I still maintain that BHP and Woodside Petroleum are safe exposures within portfolios at present, so continue to like BHP. Brambles, we've just started to reallocate into this in our internal account. Here at around 875 to 880, it's good value. A rally back up to sort of 905, we look to sell the 950 calls into June, and we collect the upcoming dividend. So continue to like Brambles on the outlook of sort of 10% earnings growth. CBA should deliver 5 to maybe 7% earnings growth coming into the div in another week or two. I think the stock will be well supported, but again, in line with our view on the broader index, if we don't see the market moving higher, it's hard to build a case that CBA rallies up and takes out that recent high, so looking for consolidation over the next 6 months in CBA. Coca-Cola, I think down here is good value, getting back to a 5% dividend yield. Not expecting much in the way of earnings growth. We've sold the 12.45 calls. We may even have a look at buying those back, given that we've locked in. We got good price for those 40 cents. I'll just review over the next few days whether it's a worthwhile trade to look at covering those and maybe getting an opportunity to reset them on a rally there with Coca-Cola. Computer share, we've taken profit on that following last January's option expiry. I always had a target back at around 10.50. Happy to take another look at it. CSL, not doing there at the moment. Well, I should just say, to the extent that we own CSL, we've sold the $71 calls. Crown, I think this is a buy on the dip down here around $16.50. It represents good value, so we'll be keeping an eye on that one in the days ahead. Fortescue, not doing there right at the moment. Fox, we continue to like this. I think sort of, with 8 to 10% earnings growth, the stock is worth somewhere around $37 to $39, so I think that's a buy on the dip. Goodman Group, really just from a yield play down here at around sort of 5%, it finds support, but 4 to maybe 7% EPS growth in the 12 months ahead. GPT, I continue to like this. I think we're positioned well here. We own it at lower levels. The company's just recommenced their share buyback a few days back. So I think at around 380 we start to look to sell covered calls over GPT, but comfortable there. IAG, we've seen their insurance margins slip, so looking for about 3% earnings growth in the year ahead, which is down substantially on the previous 12 months. Not doing there in Iluka. IPL holding up well against sort of the backdrop of the rest of the market that's sold off, and that's just simply because DAP prices are doing better. We won't really see confirmation for earnings in IPL until May, so they report out of sync with the rest of the market, but at around $3 is where we see full value there. I think Lendlease, I've maintained maintain that this is a good value opportunity over the next 2 to 3 years. It'll represent sort of maybe 8 to 10% earnings growth, so we're certainly happy to start looking at Lendlease at or near these levels over the days ahead. MGR not doing there at present, nor in Macquarie. So NAB, as with ANZ, Westpac, all the banks, I think, as they near sort of 5.5%, 6% dividend yields again, they start to get well supported. I don't see that the dividends at risk or the earnings, looking for around 5% EPS growth. Newcrest, with the risk aversion happening at a global macro level, we've seen money rotate back into gold. Newcrest had a good production report for the December quarter. On an annualised basis, they're getting back up to around that 2.5 million ounces, which, if you recall, they got down to a low sort of annualised rate of just marginally over 2 million. So the production has been above, I think, what a lot of analysts had expected, and if we can actually get gold prices moving sort of from the current 1250 range back up to around 1400 an ounce, our target on Newcrest is to see it back at around $15, and at that point we'll start to look to drive some income out of it through the selling covered calls. Origin, good production numbers. As I've alluded to in previous recordings, $15 is resistance. It's getting down to a low 3.5% dividend yield at that point. I don't think it can support a price move too much higher than that, so we're happy to cap the covered calls in Origin. Oil Search, again, good production number. I think down here is support. I think these oil and gas plays, Santos, Oil Search, start to look interesting at the moment. Again, not doing there in Qantas. QBE not doing there. Rio, again, preference being BHP and Woodside Petroleum. Stockland's down here, I think, is good value. Stockland's and Lendlease, I think, continue to make sense with the Reserve Bank pushing the recovery in property prices. But at $4, Stockland's full value, so consequently we've been selling the covered calls up here. It's getting back down to a 5.5%, 6% dividend yield here, but I'd expect to see the share price rally over the next month or two. Not doing there in Sonic. Santos, as I said, starting to represent some value down here, and we certainly on the radar in the days ahead as a potential sort of reallocation of capital there into Santos. Suncorp, as with IAG, we've seen their margins slip, so the sell-off here is largely attributed where the management had guided to around 7-8% earnings growth. That'll probably slip back down to around 4%, so we've just seen a slight adjustment in the price there, but not really on our radar at the moment. Suncorp. Transurban continue to like this 4.5% dividend yield. Sold the 725 calls. We're driving over 10% cash flow there. Telstra, I think, will recover into the upcoming dividend. Fair value here is back up at around 525. Maybe by year end it can trade 550. Right at the moment, just going through a short-term price adjustment, but I do expect to see buying interest step back in there. Toll at around 550 is about fair value, not looking for much earnings growth, back at a 5% dividend yield. Where we own Toll, we've sold the $6 call, so that's sitting well within our range. Westpac, as with the other banks, I think closing in on a 6% dividend yield will find support here in the days ahead. WDC was one of our preferred property plays. We see it value down here. I think it'll eventually trend back up towards $11 before it finds resistance. Wesfarmers, I think value again down here after sort of compressing down to a low 4% dividend yield. We're now getting back around 4.5%, 4.75% dividend yield at $41. The stock finds support. We've sold the 44 calls. We got good premium for that, about $1.50. So again, we're getting paid somewhere in the order of close to 12% on a cash flow basis from Wesfarmers as a combination of that call premium, that dividend, and our base case is that Wesfarmers largely just moves sideways through here. Same with Woolworths, similar story. Stock largely moves sideways. We're driving in excess of 10% cash flow out of holding Woolworths. Woodside Petroleum and BHP. Woodside, our target on a 5.5% dividend yield, about 8% EPS growth, should trade around $39. Comfortable with continuing to own Woodside at or near these levels. WRT moving sideways, 5.5% dividend yield, not much in the way of earnings growth. The real sort of date of note here around Westfield Retail is in, I think, around May, when WDC shareholders will vote on the spin-off of the Australian, New Zealand property assets to merge with WRT, so we'll continue to keep an eye on that. But in the interim, I really think it just largely moves sideways. And back to the index in general, so again, the risk to the market is maybe down to 4,900. And I'll jump back to the actual XJO while I reference this. So for our market, I think the risk is maybe down to 48, 4,900. That would put the US from sort of 15.4 on the Dow back down to about 15,000. I don't think you'd need to be too concerned about the global macro picture. I think the low bond yields and the central banks' focus on providing liquidity as and when needed will continue to support equity valuations. Whether today or tomorrow's the day that the market finds support, but I generally think if we look out over the next week or two, the market will start to stabilise, and we'll have an environment where we obviously get the benefit of the upcoming dividends and selling the covered calls, driving sort of in excess of sort of 10 to 12% cash flow out of a lot of these defensive names, and at the same time having the opportunity for some capital growth there. So it is a short form webinar today. So I just wanted to cover sort of a broader range of those stocks given the large shift in valuations and movements in the main indices and global equity markets. If I can help you out or you'd like to chat about your portfolio or the stocks that I've covered, please contact me 0292388188 or email leon@investorsignals.com. Thank you for listening in.